Preparing for a financial analyst at Energa interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Energa? Energa interests me because it combines essential infrastructure with a major energy transition agenda. I would enjoy analyzing regulated distribution performance, investment returns, operating costs, and renewable projects where financial discipline directly supports reliability and decarbonization. The role also offers exposure to a large corporate group and complex reporting requirements. I can contribute strong Excel, accounting, forecasting, and communication skills while learning how energy market regulation shapes commercial decisions. While answering, connect your analytical skills to Energa's electricity distribution, generation, renewable investments, regulated revenue base, and role within the wider Orlen Group. Show genuine interest in infrastructure, energy transition, and disciplined financial decision-making. Question 2. What do you know about Energa's business model? Energa is primarily associated with electricity distribution, supported by generation and renewable energy activities. Distribution provides relatively predictable, regulated revenue, but requires substantial investment in networks, maintenance, resilience, and customer connections. Generation and renewables introduce exposure to power prices, production volumes, weather, and operating costs. As part of Orlen, Energa also benefits from group scale while contributing strategic infrastructure to Poland's energy transformation. Make sure to cover Energa's core distribution network, generation activities, renewable assets, customer-related operations, regulated returns, capital intensity, and relationship with Orlen. Distinguish predictable network economics from more market-sensitive generation results. Question 3. How would you analyze Energa's financial performance? I would begin by separating operational performance from accounting or regulatory effects. I would review revenue, EBITDA, margins, depreciation, finance costs, net income, operating cash flow, capital expenditure, and net debt. Then I would bridge actual results against budget and prior year, investigating volume, tariff, price, weather, maintenance, and one-off drivers. Finally, I would connect financial movements with network reliability, investment delivery, and liquidity metrics. In your answer, discuss revenue, EBITDA, operating costs, depreciation, finance costs, cash flow, leverage, capital expenditure, operational KPIs, regulatory effects, and year-over-year versus budget variance analysis. Question 4. What are the key financial characteristics of an electricity distribution business? Electricity distribution is asset-intensive and generally operates under regulated tariffs rather than fully free market pricing. Revenue depends on approved tariffs, regulated asset values, demand, and allowed returns, while costs include network maintenance, depreciation, personnel, and financing. Cash flow can be pressured by heavy investment and regulatory timing differences. I would therefore analyze both reported earnings and the quality, timing, and productivity of capital spending. Be sure to mention regulated tariffs, allowed returns, network asset intensity, depreciation, stable demand, regulatory lag, investment requirements, service quality obligations, and the difference between accounting profit and cash generation. Question 5. How would you build a financial forecast for Energa? I would build the forecast from operational drivers rather than applying a simple growth rate. For distribution, I would model volumes, approved tariffs, customer connections, regulated cost assumptions, network losses, and capex. For generation and renewables, I would forecast production, realized prices, availability, and operating costs. I would separately project depreciation, working capital, interest, and taxes, then create base, downside, and upside cases. Focus on segment-level drivers, historical trends, tariff assumptions, electricity volumes, customer connections, operating costs, capex plans, depreciation, working capital, financing, scenarios, and reconciliation to management guidance. Question 6. How does regulation affect Energa's financial analysis? Regulation affects both the level and timing of Energa's returns. Tariffs typically reflect approved costs, expected demand, and an allowed return on regulated assets, but recovery may lag the period when costs are incurred. I would monitor tariff decisions, regulatory asset movements, quality incentives, and eligible investment recovery. A favorable tariff can support cash generation, while delayed recognition may create temporary earnings or liquidity pressure. Make sure to explain tariff approval, regulated asset base, allowed return, regulatory lag, eligible costs, quality incentives, and how regulatory decisions influence revenue visibility, cash flow, valuation, and investment planning. Question 7. Explain the difference between EBITDA, EBIT, and net income using an Energa example. EBITDA measures operating profit before depreciation and amortization, so it highlights cash-like operating performance before the cost of Energa's large asset base. EBIT deducts depreciation and therefore reflects the economic consumption of network and generation assets. Net income additionally includes finance costs, tax, and other items. I would use EBITDA for operating comparisons, EBIT for asset economics, and net income for shareholder profitability, while checking cash flow separately. In your answer, define each measure and connect them to network depreciation, financing structure, taxation, operational performance, capital intensity, and limitations when comparing companies or investment projects. Question 8. What is working capital, and what would you monitor at Energa? Working capital represents short-term operating assets and liabilities that support the business. At Energa, I would monitor customer receivables, supplier payables, energy purchase settlements, inventories, taxes, and timing differences around billing. I would analyze days sales outstanding, days payable, and unusual movements against volumes and seasonality. A profitable period can still consume cash if receivables rise, so I would reconcile EBITDA to operating cash flow carefully. Discuss receivables, payables, inventories, customer billing, supplier terms, energy purchases, settlement timing, seasonality, cash conversion, and how working capital movements can differ from reported profitability. Question 9. How would you assess an investment in a new renewable energy project? I would model installed capacity, expected production, capacity factor, power price assumptions, contract structure, operating costs, development expenditure, grid connection costs, taxes, financing, and decommissioning. I would evaluate NPV, IRR, payback, and cash-on-cash returns, then stress test prices, output, delays, capex overruns, and interest rates. I would also assess permitting and grid risks, because an attractive model is not sufficient without credible project execution. Be sure to cover project cash flows, capacity factor, power prices, subsidies or contracts, development and connection costs, operating expenses, financing, tax, NPV, IRR, sensitivities, and execution risk. Question 10. Walk me through a discounted cash flow valuation for Energa. I would forecast unlevered free cash flow by segment, incorporating EBITDA, taxes, capital expenditure, working capital, and other operating investments. I would discount those cash flows using a WACC reflecting business risk, capital structure, and market conditions, then calculate terminal value using a perpetuity growth or exit approach. After deriving enterprise value, I would subtract net debt and adjust for non-operating items. Sensitivities are essential. Focus on forecasting unlevered free cash flow, WACC, terminal value, enterprise value, net debt, equity value, regulated versus competitive segments, and sensitivity analysis around rates, growth, tariffs, and capex. Question 11. What is the difference between enterprise value and equity value? Enterprise value represents the value of the operating business available to all capital providers. Equity value is the portion attributable to common shareholders. The bridge generally starts with enterprise value, subtracts debt and debt-like obligations, adds cash, and adjusts for minorities or other claims. For Energa, this distinction matters because substantial network investment can require meaningful financing, making enterprise value multiples more informative than an equity metric alone. In your answer, define both measures and explain the bridge using debt, cash, minority interests, preferred equity, pension obligations, and other claims, with particular relevance to capital-intensive utility analysis. Question 12. How would higher interest rates affect Energa? Higher interest rates would increase borrowing costs, reduce the present value of future cash flows, and raise hurdle rates for network and renewable projects. The effect depends on Energa's debt maturity profile, fixed versus floating exposure, hedging, and the timing of tariff recovery. I would quantify impacts on interest expense, free cash flow, leverage, and valuation, then consider mitigation through refinancing, phasing capex, or stronger cost control. Mention refinancing costs, floating rate debt, project hurdle rates, valuation discounts, regulated return assumptions, cash flow, capex affordability, and possible offsets from tariff recovery or stronger operating performance. Question 13. Which KPIs would you use to evaluate Energa's distribution operations? I would combine financial and operational KPIs. Financially, I would track revenue, EBITDA margin, cash conversion, capex, and return on regulated assets. Operationally, I would monitor distributed volume, network losses, connection growth, project delivery, and reliability measures such as SAIDI and SAIFI. I would also review receivables, safety, and productivity. Together, these indicators show whether profit improvement is sustainable and consistent with service obligations. Cover EBITDA margin, distribution volume, network losses, outage measures such as SAIDI and SAIFI, connection growth, regulated asset base, capex execution, receivables, employee productivity, and safety performance. Question 14. How would you investigate a variance between actual and budgeted EBITDA? I would create a bridge from budget EBITDA to actual EBITDA, separating revenue and cost drivers. I would test volume, tariff, price, customer mix, network losses, weather, maintenance, payroll, procurement, timing, and one-off items. I would validate unusual movements against operational data and accounting entries, quantify each driver, and identify whether it is temporary or structural. The conclusion should update the forecast and recommend specific corrective actions. Explain a structured bridge covering volume, tariff, price, mix, costs, timing, foreign exchange, weather, one-offs, accounting classification, and management actions, followed by quantified conclusions and forecast updates. Question 15. What financial statement impact would a major network capex program have? Initially, the program creates investing cash outflows and increases property, plant, and equipment. If financed with debt, leverage and interest expense rise, while capitalized interest may affect the asset balance when applicable. Depreciation begins when assets are placed into service, reducing EBIT and net income. Over time, the investment may improve reliability, capacity, and regulated revenue recovery. I would track execution, funding, and returns together. Make sure to discuss cash outflows, property, plant and equipment, depreciation timing, financing, interest capitalization where applicable, leverage, regulatory recovery, working capital, and eventual operating benefits. Question 16. How would International Financial Reporting Standards 16 leases affect your analysis of Energa? Under International Financial Reporting Standards 16, many leases create a right-of-use asset and corresponding lease liability on the balance sheet. Lease expense is generally replaced by depreciation and interest, which can increase EBITDA while leaving total economics broadly similar. I would adjust leverage, debt-like obligations, cash flow classification, and peer multiples consistently. For Energa, the effect depends on leased facilities, equipment, vehicles, and the materiality of those arrangements. Discuss right-of-use assets, lease liabilities, EBITDA uplift, depreciation, interest expense, cash flow classification, leverage metrics, exemptions, and the need for consistent comparisons with companies using different lease profiles. Question 17. How would you assess whether a renewable project should be funded with debt or equity? I would compare the project's expected cash flow stability with available debt capacity and the cost of each funding source. Debt can lower the blended cost of capital and avoid dilution, but it introduces covenants, refinancing risk, and fixed payments. Equity provides flexibility but may be more expensive. I would test debt service coverage under downside production and price scenarios, then recommend a structure that protects resilience while preserving returns. In your answer, compare cost of capital, leverage capacity, debt service coverage, project volatility, covenants, ownership dilution, refinancing risk, cash flow stability, subsidies, and strategic flexibility. Question 18. Describe a time you found an error in a financial analysis. During a monthly forecast, I noticed that a cost line was unusually low despite stable operating volumes. I traced the variance to a duplicated filter that excluded one supplier category from the source data. I corrected the model, quantified the EBITDA and cash flow impact, informed my manager immediately, and added a reconciliation check between the detailed schedule and general ledger. The experience reinforced the importance of reviewing assumptions and investigating unexpected trends. Be sure to present the situation, analytical process, root cause, quantified impact, correction, stakeholder communication, control improvement, and lesson learned without blaming colleagues. Question 19. How do you ensure accuracy when preparing management reports? I start with controlled source files and a documented data to report process. I reconcile key totals to the general ledger, prior reporting, and operational schedules, then perform reasonableness checks on margins, volumes, and major movements. I use consistent definitions, version control, and clearly labeled assumptions. Before submission, I review exceptions with stakeholders and retain an audit trail so another analyst can reproduce the result. Focus on source data controls, standardized templates, reconciliations, version control, reasonableness checks, documented assumptions, review thresholds, audit trails, and clear separation between actuals, estimates, and adjustments. Question 20. What would you do if a senior manager challenged your forecast assumptions? I would first understand which assumption the manager questioned and why. I would present the supporting data, explain the methodology, and distinguish objective evidence from judgment calls. If new information justified a change, I would update the forecast and show the effect on earnings, cash flow, and key KPIs. If disagreement remained, I would provide transparent scenarios rather than forcing false precision, document the rationale, and maintain a constructive relationship. Mention listening carefully, separating facts from judgment, presenting evidence, testing alternatives, acknowledging uncertainty, revising assumptions when warranted, documenting decisions, and maintaining professional challenge supported by data. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.